Hi, and welcome to Dollars and Making Sense, a weekly program about money, finance, and investing on Radio Northern Beaches and now broadcast nationally on the Community Radio Network around Australia. I'm your host, Ray Treverson from OTG Capital, and today we're welcoming back to the microphone Peter Johnstone from the Association of Independently Owned Financial Professionals, AIOFP. Now, for our new listeners in the CRN network that goes national, you may not be aware, but Peter's actually been on the show a number of times before, so welcome back, Peter.
Thanks, Ray. Thanks for having us again.
Wonderful. Now, one of the things I was going to do today, given that we've got a new audience, there'll be the normal audience from our Radio Northern Beaches crew, but what I'd like to do is maybe get a bit of background about you and the AIOFP. So can you explain to the listeners a little bit about the association and what they do?
Yeah, so we were formed in 1998, so it's our 25th anniversary this year. We represent all the independently owned advisors and the independent advisors within the marketplace. We've got about probably 3,500 around Australia, which we represent them in Canberra. We help them with the negotiations for better deals for their consumer, for their clients. Yeah, so we're a not-for-profit organisation, so we've special tax treatment from the government, which allows us to operate a bit more cost effectively than other organisations. So what I'd like to speak to you today about is the art of selecting an advisor. Because as you know out there, Ray, it's a fairly confusing place with financial advice, and has been for probably the last 40 years, and consumers get kind of confused. Sometimes that has been an intentional confusion from the institution's point of view. So we'd like to give your listeners today some tips on what they should look for when they feel they need advice, and what they should be looking for in an advisor.
Okay, that's excellent, because certainly from the perspective that one of the things that, again, for the newer listeners to the show, you and I have been talking about the last probably 2 or 3 years now, is that the number of advisors has really changed quite dramatically over the past, say, 3 to 5 years. Maybe give a bit of background about that before we start getting into the meat and potatoes of today's discussion.
Sure. Look, about 5 years ago, there was around 30,000 advisors around Australia. Ever since the Royal Commission and it's handed down its findings, the banks were under enormous pressure, and they've now got out of advice. So what has happened, we're down to about 15,000 advisors, so it's effectively reduced by 50%. And the vast majority of those 50% who are now gone actually were working for the banks, which we're kind of pleased they're going, to be quite frank, because the banks are there operating what's called vertical integration, and that's just like having in-house advisors selling their products to consumers who walk through the front door. And we think that's conflicted, and they would sell them regardless of the quality of these products. So we think it's a good thing that all the bank advisors have moved on, but it has also affected a number of independently owned advisors who've decided to leave the industry, which is a shame, and particularly those who play in the risk space, in other words, life insurance and income protection, etc. We're down to about 800 left in Australia, which is just quite phenomenal.
Wow.
If you look at mainland China, they've got 6 million. We've got 800 left, and then you look at percentage wise, and hear that we are way behind the rest of the world with actually risk advice, which is something which is not very good for our nation.
I guess one of the aspects that I think it's self-explanatory, but I think it needs to sometimes be spelt out loud, that when people used to walk into banks and they used to go and talk to a financial advisor that had a logo from one of the big 4 banks, I often wonder what they were expecting to hear, other than being told, I guess, a sales pitch from the institution. So I can't imagine that you'd walk into one high street bank and they'd be advising and saying, look, I recommend my guy down the road who actually has a competing product. And so I think the demise of advice, and I use, and for the listeners, I'm doing a virtual inverted commas right now, but that term advice was really, I think, said tongue in cheek. And so I think I must agree with you, Peter, as an observer and an ex-advisor myself. I got out of advice about 5 years ago because I could see the writing on the wall and wanted to start my own investment fund anyway. That aside, the aspect that you could go into a bank and get a non-conflicted advice, you just sit there and shrug your shoulders. It's like walking into a retail store and expecting them to recommend their mates down the road. I guess it's just one of those strange things that finally some common sense prevailed. So look, one of the things that I wanted to talk to you today, when you talk about choosing an advisor, there are still a number of associations out there. And I don't necessarily want to go through hammer and tong, but there's been a little bit, it's certainly in change of government, which again, the AIOFP last year advocated for a change in government. And I'd certainly like to solicit your views on that a little bit later in today's discussion. But when we're talking about associations, there's still quite a few out there, aren't there?
Yes, look, there are too many within our space. There's about 12, which is just ridiculous.
12. I was thinking 5. So there's 12.
No, there's 12, and there should be one, maybe two. And what has happened is our market's dropped down by 50%, and there's still 12. Even though there is one currently emerging at the moment with another. But yeah, there's just too many associations out there, and what one of the greatest confusions within the marketplace by governments and by politicians is that they do not separate advice from product. Okay, and the reason why that is on is because all the banks have been in there flogging their own products. And what you said before is quite true. If you go to a Toyota dealer, don't be expected to be sold a Ford. Right? So if you walk in the Commonwealth Bank, they're not going to say go down the road to NAB because they get a better product. And this is where all these conflicts come into. So this is why an independent advisor is the best one to get, or independently owned as well. There's different terminations on it. So it's best to see someone who's got an impartial view, and they can point you in the right direction. And particularly today, because we're all subject to a best interest duty, right? So you can go to your advisor and they're not acting in your best interest, and you can prove it. Well, then you can take action against them. So advisors are very careful to honour that agreement, well, that compulsive law they've got, while they'll act in your best interest. But then the secret is to go to the right advisor, because it's like the medical industry. You don't, if you've got a brain problem, you don't go and see an orthopedic surgeon. You go and see a brain doctor, right? And the same with financial.
So, yes.
It's well, some people might have their brain down there, but anyway. So it's important that you select the right advisor, which is going to act in your best interest, and make sure that they specialise in the type of advice you need. Because there are, people just need little bits of advice. Some people need a whole, holistic approach. So it gets down to just a common sense question of how do I select an advisor which suits my purposes, and that's one of the key issues we want to get out there to people today.
So I guess again, the main focus of our show has always been education, Peter. And
Yep.
One of the things that we always say to people is a first port of call is Money Smart. Okay, the government website, moneysmart.com.au. It's owned and run by the federal government.
Yep.
So if they go to this website, what are they going to find when they start thinking about actually contacting a financial professional? And I'm going to use the term financial professional rather than advisor, because they can go to a number of different places, I guess, to get financial information or advice, can't they?
Yes, they can. They can go directly to institutions. You can speak to your next door neighbour there. Oh, you're still there, eh? Sorry, my screen went
Yes,
black.
I am. No, no, no.
Yep. Anyway, and yeah, so there's various options there, but you know, the Money Smart website with ASIC's good, but they don't suggest any specific recommendations on actual people, because they can't be seen to be kind of favouring one over the other. So they'll give you good general advice on what you should be looking for. But we prefer to give you a bit more information of specifically what you should be looking for, and that's probably the objective I'd like to get out to your listeners today. Exactly what to look for specifically when you are seeking advice.
It's a fascinating thing because I'm actually, whilst I was looking away for people that are watching this on YouTube, I actually dialed up and I just Googled financial advisor into the search engine, and on Money Smart it says to find a financial advisor. It says you can find a licensed financial advisor through a financial advice professional association. So they're not, and again, you're absolutely right, they're non-biased, but that association, then I guess people then have to, I guess, research again that point where they're going to do that. I think fascinatingly as well, Money Smart also points them to their super fund, their lender or financial institution, which you and I both know that's dangerous, right?
Yes.
or recommendations from people you know. That's even more dangerous as far as I'm concerned. So
Yes, old Uncle George at the barbecue is not a good idea.
or the young whip smart who's just read all about Binance and Bitcoin and going, have I got a deal for you?
Yes, we suggest you stay away from them too.
It's fascinating to me because, again, they have a search by postcode for financial advisors register. So I'm going to do a little bit more research on that and post that on the link for our show a bit later on, because I think it is important that people are understanding that there are a lot of resources out there, and a good place to start is the internet, but it's also can potentially be the worst place to start. So look, we're just about up for a break here on Dollars and Making Sense. We're going to come back. We're with Peter Johnstone, the Executive Director from the Association of Independently Owned Financial Professionals. And when we come back, we're going to start getting into the syntax of what you need to do when you are looking for financial advice. We're going to go for a short break. We'll be back in just a moment. Hi, and thank you for listening to Dollars and Making Sense, a weekly radio program about finance, money, and investing on Radio Northern Beaches and nationally on the Community Radio Network around Australia. The views, comments, and opinions aired during our program should not be construed or viewed as financial advice. Any commentary is general advice only and does not take into account your objectives, financial situation, or needs. You should consider whether the advice is suitable for you and your personal circumstances. If in doubt, you should contact an authorised licensed financial planner. We welcome questions and feedback, and you can get in touch with us via our blog, social media channels, or email. Please search for Dollars and Making Sense in your favourite podcast platform, or check out our blog at otgcapital.com.au/blog. And welcome back, ladies and gentlemen, to Dollars and Making Sense, a weekly program about finance, money, and investing. I'm Ray Treverson, your host, and at the microphone today I have Peter Johnstone from the Association of Independently Owned Financial Professionals. Welcome back, Peter. And before we went to the break, we were talking about places where people can go and find out about where they can get advice. And I guess during the break, one of the fascinating things that has also always pondered me is designations. There's a lot of people out there sort of claiming this, claiming that. So let's talk a little bit about designations. And I guess you would be a resident expert in this space. What should people be looking for when they're thinking about the designation? So let's say if we're talking about an accountant, a CPA, for example, or a CA, so the Chartered Accountants Association or the Chartered Professionals Australia, I think it is. Anyway, I'll have an accountant quiz me and say you got that wrong. But anyway, what's the equivalent in the financial advice arena?
Oh, well, firstly, I'll just make a comment about designations. We think consumers take no notice of them. For the last 20 years, we've continually surveyed our members at conferences. We've asked, has anyone ever asked whether you have a CFP or a CFS or a CPA, etc.? And the answer is no. no one has ever asked one of our members, and I'm talking 3,500 of them, whether they've actually got a designation.
Don't you find that astounding? I mean, if I walked into an accountant's office, and I've reappointed my accountant just in the last 3 years, the first thing I did was to check that they were either a member of the CPA or a CA, so that I wasn't dealing with some shonk. I mean, I'm surprised people wouldn't ask the same thing of a financial advisor.
Look, I think consumers are just too trusting. I think they just make the assumption that because you're sitting there behind a desk and you're giving advice, therefore you must be good. And it's not necessarily the case. And this, I mean, we had a situation in 2017 with the CPAs. Now, I won't mention names, but that the CEO at the time there was going around the world selling CPAs to anyone who just wanted to pay the fee so they could be a CPA, but they didn't necessarily meet the requirements. And it was just a cash flow exercise. And basically, consumers should look at designations because they are valuable to give an insight into the person you're dealing with. So firstly, we say to people out there, look for a designation to see whether these people are performing in the way you want them to perform. Now, this is part of the whole art of selecting an advisor. We think designations are important. We've put one together called the Certified Financial Strategist. It's been going about 10 years now. And what we've done there, we've sought 5 different criteria of what people should look for when they're seeking an advisor. Because we just said to ourselves, if we had to go and see an advisor, what would we want to look for in this advisor? And the first criteria is whether they're independently owned or not. It's no use, as we said before, going to a bank who's going to just sell you their own product or some other institution. You've got to go to someone who's outside of working for an institution because they're totally conflicted. And this is where the first criteria is to make sure they operate for an independently owned license. Now, what has happened in the last 25 years is you've had all these independent sounding names out there, but it's just really the institutions because they've been permitted to do it, and it shouldn't be the case. But that's what happened in the past. Like you can go and see Kilross is an example. Now they're just a brand of AMP, so they're going to sell you AMP products. That's just one example. So the first criteria is make sure that you're dealing with an independent or an independently owned advisor, and that's just really asking the question: who owns the license who they are operating under? Okay, so they can actually own it themselves, so they can be an authorised representative of another independently owned license. Now that's good. But if they suddenly say, oh, well, it's the AMP or the Commonwealth Bank, well, you'd probably say, well, we need some proper financial advice. We just don't want a product flogged to us, which is what's been happening for years.
And yet, we've had a review that's been put to the new minister. We've had a new minister now for a year, Mr. Jones, to whom you and I have both met at previous conferences, and we certainly see some promise there. But when you've got the government website saying go to your industry super fund, I mean, that's the same as walking into a bank or into AMP. There's going to be, the advice that somebody working for a super fund, even if it's an industry super fund, which has the big marketing campaigns and the like, it's still a conflicted view, though, isn't it?
Technically, yes. Look, we are never going to have the perfect marketplace. The perfect marketplace are all the advisors in one corner, operating on a fee for service with the public, and all the product manufacturers, which are super funds, banks, etc., fund managers, are in the other corner, doing their best to lower their fees and perform. So the advisors say, well, we'll put money in your fund because you've been the best. That is never going to happen. Unfortunately, our industry is. It's better we've got the banks at it, to be quite frank. The bankers won't like me saying this, but I think they're happy to be out of advice, because they're just not built to give advice. They are very good at banking. They should stay with banking.
I was going to say I'd like them to be the best banks that they can possibly be, because the 4 here have got little to no competition. They look at each other sideways, and when you think about the benchmarks around the world, we're probably operating in one of the least competitive banking markets on the planet. And I'd certainly like to see certainly some radical changes there, but that's for another time and another show. Yeah. Let's continue on. You said there were 5 benefits of being talking to a CFS advisor. So we've covered off the first, which is independence. So what's
Yep.
the second?
The second one is to make sure you've got capable, non-conflicted research facilities. One of the greatest conflicts in the financial services industry globally, it's just not here, globally, is that product manufacturers, in other words, fund managers, etc., can walk into a research house and pay them directly to rate their product. Now, it's a total conflict because it's if you ever watch that movie, The Big Short, where you've got one of the major research houses saying, well, we were paid $3 million to give that advice, and it was a very wrong advice because they were paid off. So there's so many conflicts. So we think an advisor's got to have capable, non-conflicted research facilities, and a lot of times that means they've got a panel internally which actually check out the recommendations given by the research houses. So that combined with also have a robust compliance situation within their practice, because if an advisor doesn't have proper research, they won't be in business very long, because ASIC will shut them down. So because these relationships between a client and an advisor are long term, and you want to make sure your advisor stays around long term. And the other third aspect to that second criteria is to have adequate professional indemnity insurance cover, because things don't always go according to plan. If they don't go according to plan, you need to have some way of getting your money back. Now, AFCA is one of them, the Australian Financial Complaints Authority, but also a lot of it depends on the capability of their PI cover. So that second point is make sure you've got the advisor's got proper research, they've got proper compliance in place, and also proper PI cover, just in case things don't go according to plan. So
I can't imagine I've ever seen a consumer walk into an organisation and say, "Can you please show me your certificate of currency?" But it's one of those things that, you've rightly pointed out, PJ, that without that, there's not a lot of protection, because AFCA certainly provides a lot of protection. And you and I have spoken about AFCA in the past. We've met with AFCA at the conferences, and we certainly still see some need for reform in that space. But again, is it a question that you expect the average mum and dad consumer to walk in and say, do you have adequate professional indemnity insurance? Because the first thing that the other person on the side of the desk is going to say, well, yes, but what do they know? I mean, it's like asking a brain surgeon, are you a good brain surgeon? I don't think a consumer's adequately armed to be able to, discern what is or is not. Anyway, we'll move on. Let's continue on.
Yeah,
let's continue on.
That they do that. So the third one is whether the advisor you see is whether they're capable with ASX, in other words, stock exchange, direct shares. And some people like manage funds, or they go through their super fund as an industry fund to get exposed to share market. Some like doing it directly. So we think an advisor should have both capabilities, whether it's through funds management or direct. So they should be capable in that area there. And also industry funds. Now, industry funds are very good. There's been a war going on for the past 30 years between banks and industry funds, and the industry funds have won handsomely. The banks are out of the game. Industry funds are good, and therefore you need to make sure that your advisor, if you want an industry fund, they can offer you one. And so we think that's important to have a holistic approach to financial advice. The fourth one, we think people should have a minimum of 3 years experience. It's no use having all the best degrees in the world, but you've come straight out of uni and you don't know much about anything. So we think an advisor needs at least 3 years experience. That's giving advice, so people feel confident that they're getting the right type of action, which is subject to their own requirements. And the fifth one is to have relevant qualifications. Now, some designations are all about just qualifications. We think qualifications are obviously needed, but they're not the only thing. What's the use of having a qualification if you work for a bank just selling their own bank products? The qualification really means nothing. So qualifications are part of a well-rounded advisor. So part of our role with our 3,500 advisors around Australia is that we make sure that they match up to these 5 requirements, and therefore they can become a CFS, a Certified Financial Strategist. And this is what we think consumers should be looking for. because it'll force advisors, if they're getting enough questions from their consumers saying, well, are you a CFS advisor? It's going to put pressure on them to actually become a CFS advisor, which obviously suits us, but also it's good for consumers because they know that they've qualified with those 5 different requirements to be a certified financial strategist.
And so what about fees and commissions, PJ? What should they be looking, when they're talking to a CFS advisor?
Well, they all advisors have to conform with the law, and commissions were cut out in 2012. This is commissions on investment product advice, so no one can take commission, which is good. It taken all the conflicts out of it. So you work on a fee for service basis, which is what the advisor will say to you. So here's our fees. We work for X amount of dollars an hour, or we had to do a flat fee to look after you on an annualized basis, which is the way it should be. But when, what hasn't changed is commissions on risk insurance products, in other words, income protection and life insurance, etc. We think they should stay, because risk insurance is a totally different kettle of fish to actually getting financial advice. So someone wins some money, or they retire, they walk around they walk into an advisor seeking assistance. Now, because risk insurance is intangible, because you're paying for protection in case you die or have an accident, it really people have to be forced to take it. It's one of those necessary evils, I guess you can call it, where you need protection. If you're a young person with a mortgage and you've got 3 children, etc., and suddenly something happens to you, you need to leave a lump sum back to fund your partner's future. And this is where risk insurance is so important. And what unfortunately the previous government did, they put in all this legislation to restrict the industry, and it's really had a very profound effect on Australia's welfare position. Currently, at the moment, the cost of welfare to our budget exceeds $250 billion per annum. Okay, so before you wake up on January 1st next year, we're up for 250 billion in the welfare payments. Now that has risen dramatically over the last 7 or 8 years, because people are getting out of life insurance because they're no longer, because the cost has gone too high. There's not many advisors left offering it, and we have created a really bad situation for our national financial position, because we have what's called we think it's about 2.5 trillion under insurance problem here in Australia, which means that it was about 1.8 about 10 years ago. We think it's going to be about $2.5 trillion we are underinsured for, which is not good, because that means people who die prematurely, or they've had an accident, etc., they then go on the welfare system. Whereas in the past, they've had insurance policies to actually protect them. And this is the profound negative effect the previous legislation called Life Insurance Framework, which has just about killed the industry, and it needs to be changed. And this is what we've had long discussions with Minister Jones about it. He's quite aware of it, but it's just another thing they've got to fix. This poor government, they've come in here, we've had 9 years of all this draconian action by the previous government, and Minister Jones has only been in there for about 12 months, and he's trying to fix 9 years of just stupid decisions by the previous government. So it's just going to take a bit of time.
We could certainly talk about that for quite a while, Peter, and I guess I'm always appreciative of your wonderful opinions in that space. Look, we're out of time today, Peter. It's always a pleasure to have you on the show, and thank you for listening to Dollars and Making Sense, a weekly show about finance, money, and investing. PJ, we're going to have you back on the show. Let's have a chat when you get back from your conferences and your tours around here, there, and everywhere. Always a pleasure to have you on the show. And until next time. Thanks,
Ray. Thanks, Jamie. Thank you.